In today's video, I want to dive into what the 2026 housing market predictions look like. And we're going to utilize Redfin as our source for all of this because I think out of all of the sources that report, I personally am on board with where Redfin has predicted the 2026 housing market. If you haven't already, please feel free to like and subscribe and even comment maybe your location or what you're looking for within real estate, as I cover an array of topics that are going to deal around anything real estate related, from buying and selling to investing and potentially more. So, what does the 2026 housing market prediction look like? And what am I on board with? Well, Redfin reported on an array of topics, but a couple things that I want to touch on is the market recovery with slightly lower interest rates, as well as modest to mediocre price growth, which means the pricing of housing changing, and then the increasing of affordable housing versus wages. We're going to dive into each section today, part by part, and I'd love to hear your feedback on this. So, first and foremost, Redfin is predicting that mortgage rates are going to drop. Now, they're predicting that mortgage rates get down to about 6.3%. I'm not sure when this prediction was made, but it was just publicized. And we are currently sitting at a 6.07 national average. I personally have been locking in clients below 6, and that's without any points. So I'm going to say they're a little bit off on this, but to be at 6.3, or even let's just say 6 flat. And this time 3 years ago was the last time that you saw this type of interest rate. Outside of that, we've been as high as almost 7.5% for a mortgage. So if you're one of the people that bought in the 7 to 7.5% range, I would continue watching the interest rate market, but I would tell you anytime is a great time for you to refinance currently. The next area that Redfin really hit on in this article was what they classify as modest price growth. Now, what does that mean when it comes to real estate? Well, we're going to dive back into what the appreciation is typically on a property. And I would say your norm, I'm not sure nationwide, but norm here in the Des Moines, Iowa metro is probably about 3%, depending on the era of the home. As you get newer, it does reach 4 to 4.5, sometimes 5, but that's really stretching the envelope there. But on average, let's just say 3%. Well, Redfin reported that they only anticipate a 1% appreciation increase for the year of 2026. Now, where does this benefit you, the buyer? Is it allows you to experience a little bit of a reprieve in the interest rate with the anticipation of a very minimal increase in appreciation. Thus, meaning if these predictions are true, you would actually gain buying power because the home is not going to appreciate or go up in value as quickly as what the interest rate could offset your monthly payment by, thus giving you, the buyer, more leverage when it comes to buying, allowing you to be more particular on what you are looking for in your next home. So now I want to go from the appreciation side to the increase of affordability. Now, what does affordability look like to you, the consumer, when buying? Well, affordability comes down to how much house can I afford based upon my current debt to income and or budget. Now, Redfin's predictions are that the wage increases that you will receive at your job will actually outpace the appreciation or inflation of a property. Statistically, the average rate of wage increase of the course of 2025, which was between 2.8 and 4.2%. Now, I can't find any information on roughly where they're anticipating the wage increase to go this year, but let's just say 3%. That's on the lower end of that scale. And if you're getting a 3% wage increase, but only a 1% home valuation increase, yes, 3% of, say, a $30 an hour job is only 90 cents an hour. Does that seem like a lot? No. But if you're only getting a 1% increase on, say, a $300,000 house, that's only going to be a $3,000 increase. So What Redfin is trying to do here is say that affordability becomes easier for different, we'll say, points of buying, um, within the cost of living as well as the cost of wage increase. You should actually move the needle forward this year more so than backwards, like we've seen in the previous couple of years going on. So now you might be asking, what does this mean for the real estate market? Well, what that means is Redfin is currently predicting that you are going to see an increase of transactions. Now, that increase is only going to be at 3% via Redfin's numbers, which myself personally, I would rather be conservative. It's at 3%. An unknown source that we won't name said 14% this year. I find that pretty healthy of an increase, but I would be more than happy with a 3% to say 6% increase in sales, just because I know the market has done a drastic pullback. And sadly, it downright sucks to see people put their home buying journey on hold just because of the uncertainty of what was going on in the market. So this shines a little bit of light to see the growth, but also not to see it rapid, because rapid growth would also mean rapid costs of going up. So I would love to know what your thought process is on these stats. I'm also going to pull a few more stats from another source, and I'm going to do a comparative real quick for you. So to do a comparative analysis, I'm jumping over to NAR's predictions. Now, NAR stands for the National Association of Realtors. And their predictions for 2026 in the mortgage area, spot on with Redfin, trending towards 6%, and then probably just stopping right there between the high fives and the low sixes. So, give or take a quarter of a point is the way that I would interpret the information that they're giving you. However, one thing that they are predicting, which if you pay attention to any of my other posts, and we are seeing an actual reduction of inventory right now, NAR is predicting increased inventory by up to 10%. Well, when you flood the market with inventory, you have more supply than what you're currently going to have demand. Well, ultimately, that drives down the price tag of the house. The other thing that NAR touched base on was job growth, because the recent job markets just came out and they performed better than what had been doing. So I think they're banking the inventory possibility on people moving up in their lifestyle just due to job growth. And what that's going to do is potentially lead to more affordability because of the influx of inventory coming out, which also means that it is shifting back towards a buyer's market as opposed to a seller's market, which allows the buyer to move forward with a little bit more confidence in the ability of lower interest rates, lower price tags, and more options to choose from. Now, NAR is anticipating a 4% increase in price for 2026. So, like I said, me personally, I'm going to more align with the Redfin predictions here than I am the NAR, just because I find those to be more realistic. I think NAR has inflated their numbers a little bit just based upon this last jobs report. Now, one thing that I didn't touch on yet from either one is going to be, both of them have mentioned that rents are going to go up. They both predicted a 3 to 4% increase. So if your rent is, say, $1,000, you should expect a $30 to $40 a month increase. And that sadly is to offset the job growth as well as income growth. But it's also to drive the fact that buying a home should save you money. Whereas for the last 2 years, buying a home was more expensive than renting. Secondly, they both touched base on what they're calling multifamily or generational living. And what this is meant to do is allow people more affordability, because you would have, say, parents and grandparents, or parents and children, adult children, potentially even grandchildren, all living underneath the same roof. So that way you have additional incomes to offset those expenses. Now, there has been many ethnicities that have done this for many, many years, and that's how they generate their wealth. And I am 100% on board with this. So, to sum up this entire video, we can do that in a couple of words. And that's 2026 is going to be a recovery period for the real estate market, both in price as well as activity, demand, and supply. So, it makes for a perfect storm if you're a buyer with these predictions to move forward, because it sounds like they're predicting some of the lowest interest rates we've had in 3 to 4 years, which that's already true. They're also predicting more inventory. I'm on the fence on that, as my recent market analysis has shown me otherwise for the last month. And then they're also predicting increases in rents as well as income. And that too will drive more people into the housing market, even if you're a first time home buyer. So, any questions about anything that we've discussed here today, please comment down below. As always, I'd love for you to subscribe, like, follow, give me any information you'd want to, and we'll move on from there.